Welcome to FXTech's weekly analysis. This week, we're dissecting the AUD/USD pair for the period of December 1st to 5th, 2025. We've witnessed a significant market shift, with the Aussie dollar staging its most powerful rally in months. In this video, we'll break down the fundamental drivers, key technical levels, and strategic outlook. We'll explore the growing policy divergence between a hawkish RBA and a potentially dovish Fed, and what it means for traders. Stay tuned as we unpack the data, identify the risks, and provide actionable insights to help you navigate this critical juncture in the market. Let's get started. The Australian dollar put on a stunning performance, surging 1.44% to close the week at 0.6641. This wasn't just a minor gain. It was the strongest weekly rally since September and marked a decisive shift in market momentum. The buying pressure was relentless, with the pair rallying in 10 of the last 11 sessions. Most importantly, this surge broke through a critical multi-month resistance zone between 0.6625 and 0.6635, a level that had capped gains since July. This breakout signals that the path of least resistance may now be to the upside, a significant change from the previous bearish trend. The primary engine behind the Aussie's strength is the widening policy gap between the Reserve Bank of Australia and the US Federal Reserve. In Australia, hotter than expected CPI and a massive surge in capital expenditure have all but eliminated rate cut expectations. The market is now pricing out any cuts until mid-2026. Conversely, in the US, weak data has fueled speculation for a dovish Fed pivot, with markets pricing in an 88% probability of a rate cut this December. This growing divergence is creating powerful structural support for the AUD/USD pair, making it fundamentally more attractive. While the Aussie story was one of strength, the US dollar story was one of significant weakness. The dollar index, DXY, suffered its worst weekly decline since September, undermined by a series of disappointing economic reports. PCE inflation came in lower than expected, reinforcing the narrative of easing price pressures. Consumer spending stalled, and Treasury yields retreated, removing key pillars of support for the dollar. This broad-based USD weakness provided a powerful tailwind for the AUD/USD rally, amplifying the gains driven by Australia's strong domestic fundamentals. Global risk appetite also played a crucial role. After fears of an AI-driven tech bubble caused a market wobble in late November, sentiment stabilized this week. Equity markets recovered, providing a favorable backdrop for risk-sensitive currencies like the Australian dollar. The high correlation between AUD/USD and the S&P 500, which ranges from 0.7 to 0.9, means that a risk-on environment disproportionately benefits the Aussie. As long as global markets remain calm and investors are willing to take on risk, the AUD/USD has a supportive environment for further appreciation. From a technical standpoint, the breakout is confirmed. The daily close above the 0.6625 to 0.6635 swing area was a major bullish signal. However, traders should be cautious. The rally has been very strong, with the price up in 10 of the last 11 sessions, and the Relative Strength Index, RSI, is approaching overbought territory. This signals a risk of near-term exhaustion or a pullback. Key resistance now lies at the 2025 high-day close of 0.6653 and the psychological 0.6700 level. The old resistance at 0.6625 now becomes critical support. For the next 1 to 2 weeks, we expect a period of consolidation. After such a strong rally, the market needs to pause and digest the gains. The likely trading range is between 0.6570 and 0.6700. Our outlook is neutral to cautiously bullish. The immediate challenge is the critical resistance at 0.6653. A break above this level would open the door to 0.6700. A pullback towards the 0.6600 area would be a healthy correction. The strategy is to consider buying dips towards support while being cautious about adding new long positions near the current highs. Looking out over the next 1 to 3 months, our outlook is cautiously bullish with a 60% probability. The primary driver remains the RBA Fed policy divergence. If the Fed delivers a dovish message and risk sentiment remains stable, our target is the 0.6650 to 0.6800 range. The key pivot point is 0.6653. A sustained break above this level confirms the bullish scenario. However, there is a 40% risk of a bearish reversal if the Fed surprises with a hawkish stance or if equity markets experience a significant crash, which would target the 0.6350 to 0.650 area. Navigating the coming weeks requires discipline. The biggest risk is a hawkish surprise from the Fed, as the market is heavily positioned for a cut. Data volatility is another key risk, as upcoming CPI and jobs reports will be heavily scrutinized. Strategically, it's wise to reduce leverage ahead of the December 18th FOMC meeting. Hard stop losses should be placed below the 0.6570 support level to protect against a false breakout. For those who are long, consider taking partial profits at the 0.6653 and 0.6700 resistance levels to lock in gains. In conclusion, the AUD/USD is at a critical juncture. The technical breakout above 0.6625 is confirmed, ending the multi-month downtrend and shifting the bias to the upside. The fundamental driver is the clear policy divergence between a hawkish RBA and a dovish FED. However, the rally is showing signs of exhaustion, and major event risk looms with the upcoming central bank meetings. Our final verdict is to favor buying on dips, with a medium-term target of 0.6800, but to proceed with caution and disciplined risk management. The central banks now hold all the keys,